If you are hearing this right now on Saturday, February 14th, 2026, you are not here by accident. You either already own silver, you are seriously considering adding it to your portfolio, or someone you trust has warned you that something unusual is unfolding beneath the surface of this market. What happened this week was not routine volatility. It was not random noise. And it was certainly not meaningless price fluctuation. Every major point discussed here can be verified through publicly available data from Comex, Bank of America, TD Securities, and established financial reporting. The numbers are real, the imbalance is measurable, and the implications are significant. The silver market just experienced one of the most important stress tests in modern precious metals history, and most investors barely noticed. The week began quietly. Silver was trading comfortably in the upper $70 range per ounce. Just a few years ago, those levels would have sounded unrealistic. Throughout January of 2026, the metal had been climbing steadily, building on the momentum from 2025, a year that pushed silver into territory not seen in decades. Technical charts remained constructive, momentum indicators were supportive, and the fundamental backdrop had not shifted. Global supply remained tight while industrial demand continued expanding. On the surface, everything appeared stable. But markets do not reward complacency. They challenge conviction, and this week delivered that challenge with precision timing. By midweek, the tone began to change. The US dollar index strengthened after economic data surprised to the upside. Weekly jobless claims printed lower than analysts expected, reinforcing the narrative that the American labor market remained resilient despite elevated interest rates that had persisted for over a year. Strong labor data supports hawkish arguments within the Federal Reserve. Bond yields responded immediately, ticking higher across the curve. Rising yields combined with a strengthening dollar typically create headwinds for precious metals. Silver and gold do not produce interest income. When yield-bearing assets become more attractive, algorithmic trading systems respond quickly. And on the Comex futures exchange, short-term trading is dominated by those automated systems. As yields climbed, selling pressure intensified. By Thursday, price action began reflecting tension. Volume increased as silver drifted lower. In the options market, the put-to-call ratio on silver futures rose sharply, signaling that institutional participants were hedging exposure or positioning for downside movement. What many retail traders did not recognize was that this setup was not purely organic. The concept of engineered volatility in precious metals is well documented. Over the past decade, regulatory investigations and settlements have revealed that large bullion banks have at times used concentrated short positions to influence short-term price direction. The group, often referred to as the Big Four commercial shorts on Comex, has historically held substantial control over paper silver positioning. These institutions do not necessarily short silver because they believe its intrinsic value is lower. They short because volatility creates opportunity. Here's how the mechanism works. In a compressed time window, often measured in minutes, large players release a flood of paper silver contracts into the order book. The sudden surge overwhelms buy orders. Price breaks below widely watched technical levels. Retail traders typically place stop-loss orders just beneath those levels to protect capital. When price breaches those zones, automatic sell instructions activate. That forced selling pushes price lower, triggering additional stops in a cascading sequence. Once liquidation pressure peaks, institutions step in and repurchase short contracts at reduced prices. The difference becomes profit. This process has been labeled many things over the years. Liquidity event, stop-loss hunt, long liquidation cascade, shakeout. The terminology varies, but the mechanics remain consistent. On Thursday night, as Asian markets opened and European traders closed their sessions, conditions aligned for such a move. Financial media had already amplified strong employment data and hawkish commentary surrounding Federal Reserve nominee Kevin Warsh. Discussion framed his potential influence as supportive of higher rates for longer, which on the surface appears negative for precious metals. But while the paper narrative suggested weakness, something entirely different was unfolding in the physical market. In Shanghai, the premium that Chinese buyers were paying for physical silver compared to the Western spot price expanded to approximately $10 per ounce. In modern markets, a $10 premium is extraordinary. To understand its significance, you must separate the paper-silver universe from the physical one. Paper-silver trades primarily on the Comex futures exchange in New York. Contracts representing 25,000 ounces each are exchanged electronically between banks, hedge funds, and algorithmic systems. Most contracts never result in delivery. They are financial instruments used for speculation and hedging. Trading volume regularly exceeds actual global mine production by multiples. The physical silver market operates differently. It consists of refined bars, coins, and industrial supply that must be mined, processed, transported, and stored. It is governed by tangible supply and demand constraints. When the paper price declines, while the physical premium rises, It sends a clear signal. It suggests that futures pricing may be temporarily suppressed below the level where real-world buyers are willing to transact. The $10 Shanghai premium was effectively broadcasting that imbalance. Chinese industrial consumers who rely on silver for solar manufacturing, electronics, and other applications were not waiting for lower prices. They were paying up because supply was required immediately. This divergence created what professionals describe as an arbitrage vacuum. Under normal circumstances, traders would purchase silver in the cheaper Western market and sell into the higher-priced Shanghai market, narrowing the spread quickly. But February 2026 was not normal. The arbitrage mechanism failed to close the gap because Western vault inventories were insufficient. And that leads directly to the most critical figure in this entire narrative. For the first time in modern recorded history, registered silver inventory on Comex fell below 100 million ounces. Registered inventory represents metal that is approved and available for delivery against futures contracts. As of this week, the official total stood at approximately 98.1 million ounces. At a price near $77 per ounce, that inventory carries a total market value of roughly $7.7 billion. To provide perspective, $7.7 billion is less than the market capitalization of many mid-sized publicly traded companies. A single quarter of revenue from Apple Incorporated exceeds the total value of all deliverable silver currently sitting inside Comex vaults. Yet silver is essential to advanced technology, renewable energy infrastructure, medical systems, electronics, aerospace, and military manufacturing. At the same time, total open interest in Comex silver futures exceeds 400 million ounces. That means for every physical ounce registered for delivery, there are roughly 4.3 paper claims outstanding. Picture a room with one chair and more than 4 participants circling it. As long as most agree to accept cash settlement or roll contracts forward, the system operates smoothly. But if too many decide they want the chair, tension rises instantly. This is not speculation. It is arithmetic. And this week, that arithmetic moved from theory to visible stress. When you place 98.1 million ounces of registered inventory against more than 400 million ounces of open interest, the imbalance is not subtle. It means the futures market functions only as long as most contract holders agree not to demand metal. The structure relies on confidence. It relies on rollover behavior. It relies on participants accepting paper settlement instead of physical delivery. But if even a relatively small percentage of longs choose to stand for bars, the strain becomes immediate. This is not theoretical. It is the exact dynamic that institutional analysts have quietly acknowledged. Bank of America commodity strategist Michael Widmer addressed the structural deficit in a widely circulated research note. Widmer reaffirmed a long-term silver price target of $39 per ounce. That figure represents roughly a 4-fold increase from historical reference levels during previous cycles. And importantly, it does not come from speculative commentary. It comes from one of the largest financial institutions in the world, managing trillions in capital and advising major funds. Widmer's thesis rests on a simple structural argument. The silver market has entered its 6th consecutive year of deficit. That means global consumption continues to exceed annual mine supply plus recycling. China alone installed more solar capacity in 2025 than the entire world installed in 2023. Its 2026 targets are even higher. India is accelerating solar expansion. The Middle East and Southeast Asia are doing the same. Solar panels require silver for electrical conductivity. That demand is not optional. Meanwhile, primary silver production is struggling to expand. Ore grades are declining globally. Energy costs remain elevated. Environmental regulations extend permitting timelines. The easy deposits were discovered decades ago. Developing new mines requires years of exploration, financing, and construction. Supply growth cannot match accelerating industrial usage. This is the structural backdrop that framed what happened on Friday, February 13, 2026. When New York trading opened that morning, conditions were aligned for a calculated assault on price. The dollar was firm. Treasury yields were elevated. Hawkish Federal Reserve commentary remained active. Even the psychological weight of Friday the 13th contributed to negative sentiment. Within the first hour of Comex trading, a concentrated wave of sell orders entered the market. Silver broke below the $77 support zone with speed. The initial volume spike was abnormal, far exceeding typical opening activity. As price breached 77, stop-loss orders triggered almost immediately. Retail traders often place protective stops just beneath round numbers. When that level failed, automatic selling cascaded. The first wave pushed silver into the 76 range. A second cluster of stops was waiting there. Once activated, the liquidation intensified. Algorithms amplified momentum. Within hours, silver printed an intraday low of $75.50. From recent highs, the decline exceeded 5% in a compressed time frame. For traders using leverage, the drop triggered margin calls. Brokers required additional capital to maintain positions. Those unable to provide it were liquidated at depressed prices. Positions were closed not by choice but by force. This is the hidden cost of a stop hunt. For institutions carrying large short exposure, however, the decline offered relief. TD Securities, a major participant in precious metals trading, had previously been reported as holding substantial short positions. Earlier in 2026, financial coverage indicated that losses had accumulated as silver advanced. A drop toward 75.50 provided an opportunity to reduce short exposure at lower prices. Every dollar lower reduced pressure on short books. Each incremental decline translated into meaningful adjustments in unrealized losses or realized gains. The incentive to drive price through visible support was obvious, but here's where the event diverged from routine volatility. At $75.50, selling pressure met resistance. The bids clustered between $75 and $76 were not dominated by small retail accounts. They reflected industrial consumers securing supply, sovereign funds diversifying reserves, and large institutional investors, often categorized as smart money. These buyers had been waiting. When price dipped aggressively, they absorbed available contracts. The response was not hesitant. It was decisive. Within minutes of printing the 75.50 low, silver stabilized. Short sellers recognized that further downside would encounter even stronger demand. As stabilization took hold, short covering began. Institutions that had sold into weakness needed to buy back positions before the rebound accelerated. This is the anatomy of a bear trap. Sellers push price lower to trigger panic, only to find that their own selling creates a durable floor. Once covering begins, upward movement feeds on itself. By the closing bell in New York, silver had recovered fully, settling at $77.41 per ounce. That closing price carried technical significance. On the weekly chart, the candle formed what technicians describe as a hammer. A hammer displays a long lower shadow and a relatively small body near the top of the range. Visually, it communicates rejection of lower prices. Sellers drove the market down, but buyers reclaimed control before the week ended. Historically, weekly hammer patterns appearing after corrective pullbacks often precede renewed advances. The last comparable formation on silver's weekly chart was followed by sustained upward movement in subsequent weeks. Equally important was the relationship to the 50-day moving average. The 77.41 close held above that key level. Institutional traders monitor the 50-day moving average as an indicator of intermediate trend direction. Closing above it reinforces the view that the pullback was corrective rather than the start of a structural downturn. In the days preceding the sell-off, bearish commentators had highlighted a potential head and shoulders formation. That pattern requires a decisive breakdown below a neckline in the mid-$70 region to confirm reversal. Instead of collapsing, price rebounded and invalidated the setup. A failed head and shoulders can become a powerful bullish signal. Traders positioned short expecting breakdown may be forced to cover if the pattern fails. Their buying adds fuel to the next upward leg. Technically, the market strengthened through adversity. Fundamentally, inventory stress remains central. The Comex warehouse system divides holdings into eligible and registered categories. Eligible silver meets purity standards and is stored in approved vaults, but it is not committed for delivery. Registered silver is specifically warranted and available to fulfill futures obligations. The sub 100 million ounce figure refers exclusively to registered inventory. While eligible inventory exists, its owners are not obligated to convert it to registered status. Recent trends show metal moving from registered to eligible, effectively tightening deliverable supply further. That shift signals that physical holders prefer to retain control rather than make silver available for exchange settlement. Now consider timing. The March 2026 silver futures contract is a major delivery month. First notice day arrives on February 27th. After that date, long contract holders may demand physical delivery. Between now and then, traders must decide whether to roll positions forward or stand for metal. With registered inventory historically tight and Shanghai premiums elevated, delivery interest bears watching closely. If even a modest fraction of March open interest elects delivery, pressure on vault supplies could escalate rapidly. This is the scenario professionals refer to as a delivery squeeze. And as February progresses, that possibility moves closer to center stage. Now widen the lens, because silver does not exist in isolation. It responds to fiscal expansion, monetary constraints, geopolitical tension, and structural shifts in industrial production. When those forces are layered on top of what we just witnessed, the implications become even more compelling. The United States continues operating under fiscal deficits that would have been considered extreme in prior decades. Debt to GDP levels remain elevated. The Federal Reserve finds itself constrained. Raising rates aggressively risks recession. Cutting too soon risks reigniting inflation. This policy trap weakens long-term confidence in fiat purchasing power. Hard assets historically perform well in environments where monetary credibility is strained. Central banks have accumulated gold at record pace for several consecutive years. Silver, traditionally categorized more as an industrial metal, is increasingly appearing in broader reserve diversification discussions. China has steadily expanded precious metal holdings as part of its strategy to reduce exposure to dollar-based financial dominance. Geopolitical instability adds another layer. Trade tensions, tariff policies, regional conflicts, and supply chain fragmentation create persistent uncertainty. In such conditions, tangible commodities with industrial necessity and monetary characteristics gain strategic importance. The energy transition remains the single most powerful structural demand driver for silver. Solar panel manufacturing requires it. No commercially viable substitute matches silver's electrical conductivity, thermal efficiency, and durability at scale. Electric vehicles incorporate it. 5G infrastructure depends on it. Advanced medical devices, aerospace systems, military hardware, and water purification technologies rely on it. This demand growth is measurable. It is not speculative enthusiasm. It is production-based consumption expanding year after year. Supply, by contrast, remains constrained. Developing a new primary silver mine typically requires 7 to 15 years from discovery through production. Exploration programs, environmental studies, permitting approvals, capital financing, and construction extend timelines. Even if companies launched aggressive investment campaigns today, meaningful new supply would not arrive until the early 2030s. This is what economists describe as inelastic supply. When structural demand rises into constrained supply, price must eventually adjust upward to ration consumption or incentivize new development. At approximately $77 per ounce, neither widespread demand destruction nor massive new mining expansion has been triggered. That suggests equilibrium pricing may ultimately need to move higher over time. This does not eliminate volatility. The path from $77 to higher projected levels will not be linear. There will be additional shakeouts. Stop-loss cascades will occur again. Headlines will amplify fear during corrections. That is how trading desks monetize emotion. But beneath the noise, the structural framework remains intact. Now consider the immediate calendar context. As of Saturday, February 14, 2026, U.S. markets are closed for the weekend. Monday marks President's Day, extending closure to 72 hours. During this window, Comex trading pauses. However, Asian exchanges, including Shanghai, remain active during portions of this period. If Eastern physical demand persists at current premium levels, price discovery during those sessions could influence reopening conditions in the United States. A gap higher on Tuesday would mean silver opens above Friday's 77.41 settlement, forcing remaining short sellers to adjust rapidly. Institutional conviction is often revealed through positioning ahead of extended breaks. Large funds had the option to reduce exposure before the long weekend. Instead, buyers absorbed the decline and held positions into closure. That behavior signals confidence in underlying support. First notice day for the March 2026 contract arrives February 27th. Less than 2 weeks separate the market from that deadline. Each passing session increases the tension between short sellers seeking to avoid delivery and long holders evaluating whether to stand for metal. If delivery interest exceeds comfortable thresholds relative to registered inventory, pressure could intensify quickly. Unlike 2011, when speculative leverage drove silver above $40 before multiple margin increases crushed momentum, the current environment is anchored in measurable physical tightness. Inventory levels relative to industrial demand are materially different today. You cannot create silver through monetary policy. You cannot accelerate geological formation. Supply constraints are tangible. The reversal from $75.50 back to $77.41 offered real-time evidence of physical buying strength overpowering paper-selling pressure. The weekly hammer formation reflects collective rejection of lower valuation. For investors holding physical silver in coins or bars, this week reinforces structural conviction. The attempt to push decisively below $75 failed because genuine demand emerged aggressively. For holders of mining equities or silver-linked funds, volatility will remain amplified. Mining companies typically exhibit leverage to underlying metal prices. A sustained move higher in silver could translate into disproportionate equity gains for firms with strong balance sheets and scalable production. Risk discipline remains critical. Dollar cost averaging remains effective. Allocating fixed capital at consistent intervals reduces emotional timing errors. It allows accumulation during dips and moderates entry during spikes. Now return to the core imbalance. With registered inventory at 98.1 million ounces and open interest exceeding 400 million ounces, the leverage embedded in the future structure is evident. If even a fraction of long's demand delivery, vault drawdowns could accelerate meaningfully. A full force majeure declaration remains unlikely, but even open discussion of that possibility highlights structural stress. Exchanges function on confidence in settlement integrity. If participants begin questioning deliverability, pricing dynamics can shift abruptly. Institutions understand this risk. That is precisely why shakeouts intensify ahead of major delivery months. Encouraging liquidation before first notice day reduces potential delivery pressure. Yet this week's reversal suggests many participants are not capitulating. The road forward will continue testing patience. Price may revisit support zones. Economic data releases will drive algorithmic swings. Federal Reserve commentary will generate volatility. Strong employment or inflation prints will cause intraday spikes and dips. But structural deficits do not resolve overnight. The silver market just absorbed one of the sharpest intraday declines of 2026 and closed the week above critical technical levels. That is resilience, not weakness. As February progresses toward the 27th, monitor registered inventory closely. Track Shanghai premiums. Observe open interest adjustments. These metrics carry more weight than short-term sentiment. If the March contract navigates delivery without stress, tightness remains visible. If delivery interest rises sharply, pressure increases further. Either outcome reinforces the broader narrative of constrained supply meeting expanding demand. The events of this week may later be recognized as a pivotal moment. The $75.50 low demonstrated defense by physical buyers. The $77.41 close confirmed preservation of technical structure. Markets evolve in phases. This phase showed that concentrated paper selling can generate temporary volatility, but it cannot permanently suppress structural imbalance. For disciplined investors, the longer-term trajectory continues to point toward higher equilibrium pricing. The silver market endured a coordinated stress test, absorbed supply, defended support, and now approaches a major delivery month with historically tight inventory. Remember the numbers, remember the hammer, remember the arithmetic. Because in markets where supply is finite and demand expands persistently, price eventually aligns with reality.